joining here to discuss some of his funds and the overall market. Meb is the CIO of Cambria Funds and portfolio manager of the funds, which include the tail risk ETFs. So Meb, I want to start with tail because, of course, with the big event this year, you got a good test of the fund. Walk us through how it functions.
You know, we last spoke about this about a year ago, and it feels like quite a bit's happened in the meantime. If you and I were to go back to the chat we had probably 14, 16 months ago,
yep,
and I was to give you the playbook of all the economic variables of what's happened, where gold is ripping, as you just mentioned, oil futures trade negative at some point, unemployment went from 4 to 15. Interest rates at the Fed went from 2.5 to 0. All these things, PMI creators, and I would have said, where do you think stocks would be? And you were to tell me, well, they're not only up, they're close to hitting all-time highs. I think we would both be surprised, but here we are. And that's the thing about investing. It doesn't just connect 2 points, right? It's the path along the way. And so as we spoke about last time, we're chatting about how to hedge market risks. There's a lot of ways to think about that. The first is just not to take the risk in the first place. So don't own so much of whatever you're trying to hedge. And right now we're talking about U.S. stocks. Second is you diversify into other things. The problem for a lot of people with that is they diversify into things they think or expect to help that probably won't. So foreign stocks, real estate, commodities, all historically have not helped. We did a paper on this called Worried About the Market. And then there's some things that do help. Bonds usually help, often not a lot. Gold helps, but only sometimes. Sometimes when the stock market gets slammed, gold does poorly too. And one of the things that's almost guaranteed, can never say that in investing, to help and hedge is buying puts on the actual market. And so the way when we launched the fund over 3 years ago now, we said, what's the most common sense, basic way we can put together some of these elements that we would want to invest our own money into? And so we paired 90% of the fund-ish is in 10-year U.S. government bonds. And historically, that's been a great premium, 4 or 5% income per year. Now, not so much, but you get often capital moves when bonds do well in times of stress for U.S. stocks. You've seen that this year. I think those bonds are up double digits. And then with the remainder, we buy a ladder of puts. So ranging about from 3 months on out to about 15. It gives you a laddered exposure to the stock market downside. And as you mentioned, you've had about 9 different regimes of stock markets in the past 3 years. You had the 2017 regime when the market went up for the first time in a calendar year every month. And then 2020, which just the beginning of a decade, 6 months in, has felt like an entire decade already. But we designed the fund to be simple and something that people, so much of this category is so complicated and expensive too. One of the most expensive categories out there. And we wanted this to be something people understand.
It's up 14.5% on the year, got up to 39% during the middle of the selling when things were getting really bad. Do you have to reassess which parts of the tail components will function the best in any given scenario? Because when I have the gold folks come on here right now, they're taking victory laps and they say that bonds basically are next and that all the monetary blowback is going to prevent bonds from functioning properly. And while they did this time, we can't forget bonds had a real bloodbath there for a couple days. They did the job on a net basis, but they got pretty rocky there too. How do you assess whether or not there are risks now as we've changed the bond market so much?
As you think about markets, the thing we always continue to learn is that the future will be different. 2020 has been no exception. For the first time in history, we had the fastest from all-time high to a bear market in history in the U.S. stock. We've never seen that before. So things continually surprise us. One of the things that surprised me over the past 10 years has been the steady march down in bond yields. And you got to remember, U.S. bonds are historically last few years have been a high yielding sovereign bond. And that's not saying because the U.S. bonds have such a magnificent yield, they don't. It's because the rest of the world has negative yielding bonds. And so as you think about sovereigns, a lot of people say, oh my God, I can't believe it. We're at 50 bips on the 10-year. What if it goes down to 0? Well, you at least have to mentally prepare for the possibility, however rare or small you might think it be, that U.S. bonds could trade negative. They didn't teach that to us in the textbooks when we were undergrads, of course, but you also have to prepare for bonds to go up. But the stock puts, one more comment, as you mentioned, what's happened this year. You usually don't want to be buying puts when VIX, the event's already happened, or when VIX is up at 60, 80, right, which it was in March. And so we have a natural feature of this fund that buys less puts when the VIX is high or expensive and more when it's low, like it has been in the past couple of years when it's down around 10 or even below 10. So it's a way we hope, of kind of buying low, selling high as well, and that's an important feature.
So right now, as an investor trying to allocate based on the probability, the outcome probabilities of the future, which are obviously very tough to figure out right now, does it make sense to have a tail risk fund like this, or does it make more sense to go into one of your other funds or whatever funds they choose to get exposure to things like international value or things even like domestic value? You look at the last couple weeks and there's been real hints of a stage being set here for rotation. It hasn't quite caught on yet, but it seems like there's real potential for something to change here as we watch the dollar drop, euro take off, etc.
Well, we have 11 funds, and they're all my children, so I love them equally. But, the way the world looks to me and our team at Cambria is there's no question that U.S. stocks are expensive. Question is, does it matter? They trade for a long-term PE around 30, but in the past they've traded as high as 45 in the 90s bubble. Other markets like Japan and their 80s bubble hit almost 100 PE. So you've seen it in the past, the possibility where U.S. stocks could go up 50% from here just to reach the bubble highs and triple from here to reach Japanese highs. Is that probable? Is it likely? No, but it is possible. On the downside, though, and if you look at Bogle's famous equation about projecting expected stock returns, we're low single digits for the U.S. stocks. Not great, not horrific, not minus 10 per year, but not good. The good news is the rest of the world is reasonable to downright cheap to screaming cheap. So we always talk about both tails. If you're gonna invest in stocks, you at least gotta have market weight in foreign stocks. So we have value's been destroyed the last few years. You're getting a massive alligator jaw spread of global stocks to U.S. stocks. But then this year, you're also getting small cap value, huge spread versus U.S. stocks. They were down like 50% in Q1. So you're having a bunch of opportunities. And if you haven't done it yet, the chance to move outside our borders, emerging market value. We have a shareholder yield fund is one of my favorite funds, global value. Again, those are screaming cheap relative to the U.S. At least have, we think, half your money outside the U.S. And then, of course, round it out with a lot of the other stuff. Y'all know I'm a trend follower at heart. And a lot of the trends, despite how much you see the markets ripping, some of the best performing momentum has been not only bonds, but also gold miners, as you mentioned, and then for the sectors, a little tech and healthcare. But the whole point of all this stuff we talk about is having a plan, putting it all together, and sticking to it. So when something like March happens again, eventually, it may not be next month or the following month, maybe next year, who knows, you have a way to get to the finish line. And that's kind of where tail ties in. It's more of an insurance ability to get you to behave for the rest of your portfolio, so you can eventually, withstand all the jiggles in between.
I was listening prior to this, your interview with Doug on your podcast, Doug Ramsey from the Luthold Group, regular here on the show, and he's, of course, talking valuations, a really good segment for those who want to go check it out. One thing I was thinking about from that is you guys discuss the ability of using valuations as a timing tool. Everybody knows it's very difficult to do. Doug says this, it's impossible, basically, but they can at least try and give you a range of outcomes, or maybe you can gauge the odds, to your point about whether or not the market will melt up, right? It could, it has in the past, but are the odds in favor that it could? How does the rate situation change those odds? Because there's a lot of folks, they point to the Fed model saying, well, rates are low, we need to rethink valuations. And I know there's a lot of holes you can poke in that, but at the same time, right now, if we get a fiscal plan that comes through that's able to restart the economy in a decent way, if it looks like we just avoided a depression, I mean, all the data says it should be this massive depression, and it's not, then should we start to rethink what kind of the median valuation should be for stocks and equities?
Well, let me give you a couple interesting points. Back in March, we wrote an article on the blog called Investing in a Time of Corona, where we laid out potential bull and bear cases. And like you mentioned, we laid out a depression case, in which case valuations sail right through average valuations all the way back down to global financial crisis lows, where the PE got down to the low teens. Remember, it's back up around 30 now, but we were low 20s in March. But also we laid out a bull case where we said we're going to be hitting all-time highs by year end. And everyone's like, that's crazy. There's zero chance of that happening. But here we are. So you at least have to think through the possibilities. But as you think about maybe a new normal with valuations and everything else, everyone always says, well, U.S. stocks, interest rates are low. They deserve to be higher. And my response is always, well, what about the rest of the world? The rest of the world isn't expensive. It's cheap to downright really cheap. And for the last 50 years, if you compare U.S. to foreign stocks, the valuation premium of the U.S., which is, again, 30 versus 20 essentially right now, so 50% higher than foreign stocks, the valuation premium has been zero. They both have traded around the long-term PE around 22, which is higher than the historical 17, but it's partially because of this low inflation environment, which ties right into interest rates. And so you have this opportunity where all of the multiple expansion has come since 2009 in the U.S. You go back to the 80s, we talked about this last year, where we said the valuation spread versus the rest of the world is the biggest it's been in 40 years. But in the 80s, the U.S. was cheap and the rest of the world was expensive. These things have a way of zigging and zagging, but going back to the timing tool, any investing approach, not just value, stocks versus bonds, anything, we used to say you need a decade for it to work out. Now I say 20 years. People always ask me weeks, quarters, months, what's going to happen? I say you need a long time period. That's how these things play out. So no help on the next week or next month, but over the next 10 years, absolutely would be betting on the cheaper valuations versus the U.S.
For the U.S. story for valuations and some of the beaten up stuff, do you need to have rates move the other direction to get a real thematic shift? Do you need to have rates pick up for value as a trade to do well? There's banks in there in the mix. It seems like the two might be closely tied.
The catalyst is always obvious in retrospect, and we go back through history, and geopolitics is always sort of a negative. People are always worried and anxious about anything, but as much as I sound bearish on U.S. markets, I'm an optimist, and these markets, you want to own businesses and equities over the long time horizon regardless. Some of the most bullish ideas, locations, geographies we love the concept of Africa. We love emerging markets value, where if you look at all the demographics lining up, not just that with the valuations too, you have an incredible story. And so, again, but you don't want to put all your eggs in Russia or Czech Republic or, one country. You still want to diversify. But the idea of only looking at the U.S., which is what most U.S. investors do, they put 80% in U.S. exposure. Forget about global sovereign bonds, by the way, which is the largest asset class in the world. No Americans put anything in global bonds. But having a global perspective has shown historically for the last 12 decades to be a much more sensible approach than betting on any one country, including the U.S.